Hello and welcome to a very special edition of Indianomics. Things seem to be falling in place in the Indian economy. The February inflation was lower than even the MPC target, given target of 4%. And on the other hand, the industrial output number for January has come in at 5%. Given that the April-January number is only 4.2, this definitely looks like a breakout number. So inflation lower than expected, growth higher than expected. But will our economy, its recovery, be blunted by the kind of globe in which we are sitting? Just this week itself, countries across the Atlantic Ocean, which have been friends for over a century, are imposing tit-for-tat tariffs on one another. Europe on the US and US on the Europe. And likewise, there are tit-for-tat tariffs between US and Canada as well. And the other surprising factor, therefore, is that the US economy may go into stagflation or recession, but Europe is emerging as a surprising area of growth because after 3 decades, Europe and Germany have decided to increase their fiscal deficit by 1%. Now, it's clearly a rudely disturbed world, and we need the advice of an expert. So today, my guest is the veteran policymaker from India, former Reserve Bank of India Governor, Dr. Subbarao. Dr. Subbarao, thank you very much indeed for finding time for me for this show.
Thank you.
Well, first up, let me start with the immediate Indian economy numbers. Inflation coming lower than expected. Industrial growth finally seems to be breaking out of the low single digits. Do you think we are on a path to recovery from that slowdown we saw in the second quarter?
It is good to start on a positive note, Latha, and I knew that that's got to be a headline question.
Okay.
I saw the inflation number which came last evening, 3.6%, which is comfortably within the inflation target. And also, as you mentioned, industrial production has improved. Growth. On the other hand, there's concerns about growth, and I believe the rupee has adjusted for the time being. So I believe, I'm a bit wary about commenting on the RBI's policy options, but I believe there is quite a good scope for further easing. But what I want to say is this, that monetary policy has only limited potential to push up growth, because monetary policy can push up growth to the potential level. But pushing up the potential level of growth itself is the responsibility of the government, responsibility of fiscal policy and development policy. So we've got to understand that. Yes, as much as there is an opportunity for the Reserve Bank to ease further, we've got to understand the limitations of monetary policy in raising growth beyond the potential growth rate.
Oh, yes, that's an important lesson you're telling us, that the Reserve Bank can move within the potential that the fiscal policy, the economic policy sets. But do you think we are in a cyclical slowdown only, or is there something structural that we are unable to break out above the 7%?
Well, I've studied all the people who've weighed in on this issue, and that there is opinion on both sides. There's some people who say it's cyclical, some people who are more cynical say structural. Those who say cyclical say that, there is a global headwind, there is a tariff war, there is a trade war, there is geopolitical tensions. Domestically at home, the Reserve Bank was on a tightening stance. There's fiscal consolidation. Therefore, the growth to some extent is constrained. But over the last 3 years, the government has spent an enormous amount on public infrastructure. That's going to crowd in private investment now. Moreover, the budget has given a boost to consumption. That too will add. Therefore, good times will come. This is just a cyclical blip. We will be back to a high growth trajectory. That's the cyclical view. But on the other hand, there are structuralists who argue that our catch-up growth potential has been exhausted. In fact, if you go back to pre-COVID time, growth was actually slowing. 2017, 18, 19, 20, growth was slowing from 7%, 6%, 5% to 4%.
Yes.
The rapid growth we saw over the last few years is actually a rebound from the COVID blip. There was revenge consumption. Okay. Afterwards, the government took over and spent on public investment. But those drivers are now exhausted. The question these people ask is, where are the growth drivers? The economy grew at 8% last year, 8.2%, but consumption grew at less than 4%.
Yeah.
So if consumption does not grow, can we maintain a high growth rate? Private investment, just about 25% of GDP in 2008, is today about 12 to 13%. Net exports, the situation is bleak. It's a leap of faith to believe that the global situation will improve dramatically in the next few months or even few years. And the government's ability to spend is limited. So where is the growth driver is the question the structuralist asked. My view is that our growth slowdown is partly structural and largely cyclical.
Okay, so you would blame the Reserve Bank for being a little too tight with its liquidity last year?
Well, I wouldn't blame them in that sense because I believe the Reserve Bank was enjoined to maintain a tight policy. After all, inflation was above the target for a considerable period of time. So they had to keep interest rate high, as also run a tight liquidity regime. There is some sacrifice of growth because, after all, the objective of tightening is to choke demand. And when demand is choked, there is some constraint on growth. To some extent, growth is compromised. But that is only in the short term.
Yes.
In the medium to long term, I believe low and steady inflation is a necessary condition for growth. So I think it's unfair to blame the Reserve Bank of India.
Yes, to be fair, they smelt the problem in the unsecured loans earlier than anyone and raised risk weights. And even today, they've maintained those risk weights for all the other loosening. But let me come to the big question, really, the one that is confronting us globally. What is your take now? Where are we headed with President Trump announcing reciprocal tariffs? Is April going to be a terrible month for us?
Well, I cannot give an expert view. There's too many things happening. He slapped tariffs on Canada and Mexico, deferred them, slapped tariffs in China. China has retaliated, slapped tariffs on aluminum and steel, and threatened tariffs on dozens of countries, including India. So there's just too many moving parts, and it's difficult at this time to decide where this is going. But one thing is for certain, this is not going to be a painless option for America, because tariff increases are going to raise inflation in America, and there's going to be pain there. Moreover, the ostensible objective of Trump's tariffs is to reshore manufacturing to America, generate jobs there, and reduce current account deficit. Actually, it's not clear that this objective should be realized. In fact, what might happen is maybe the opposite. For example, if there is already talk about tariffs raising the cost of manufacturing in America, particularly cars. Some car companies are contemplating cutting down production. So jobs will be lost, and imports might actually increase, raising the current account deficit. So there is going to be a backlash because of inflation, because of job losses, because of high current account deficit. To what extent can Trump countenance this backlash will determine how we go forward. About India, we've got to recognize that America is our largest trading partner, and one of the few countries with which we have a trade surplus. Of course, it's threatened us with reciprocal tariffs. There is called us the tariff king, actually.
Yes.
And we made a lot of concessions over the last few months during the budget, before the PM's visit to Washington, during his meeting with President Trump. Even after he came back, we agreed to import more defense, more energy, reduce our trade surplus with America. And there's talk about an FTA. But an FTA is not going to be all that easy. There is the very critical issue of agriculture affecting millions of livelihoods. And it's also not clear to what extent they will raise non-tariff barriers. But assuming or expecting that we will have a reasonably good FTA by September, as the government is assuring us, the best option for India, or best scenario for India, would be that we have an FTA with America, and it slaps tariffs on China and other countries. then we'll have a window of opportunity for trade diversion, for example, as happened during Trump's first term. We got a lot of trade diverted to us because of tariffs on China. So that's the first opportunity. And a more lasting opportunity will be the China plus one option, that India might become the plus one. But this is conditional, again, on a reasonably good FTA and we getting our act together. Both are two big Fs.
Okay, I agree with you, sir. We should know about the FTA sooner, but getting our act together, of course, is going to be a long-standing effort. But, you know, as an economist and a central banker, I just wanted to clarify one seeming contradiction in what President Trump wants. On the one hand, he wants lower current account deficit. That's what he's arguing with everyone. But on the other hand, he gets, I mean, he wielded a stick even at the BRICS countries because we want to move away from the dollar. Now, you can have dollar as the global currency only if the US has deficit, because they will print dollars to bridge the deficit. These are contradictory goals. How will they play out?
Yeah, that's an important contradiction you're pointing out, Latha. Good point, actually. You know, the reality is that the dollar is the world's dominant reserve currency. Much of international trade and finance is conducted in dollar. And significantly more than half of central bank reserves are held in dollars. So in order for this to happen, there's got to be sufficient dollar liquidity in the global system.
Yes.
And for that to happen, America has to run a current account deficit. So to simultaneously expect the current account deficit to come down and to maintain dollar hegemony is a contradiction. But I want to also point out that it's not as if America is doing the world a favor by running a current account deficit, as actually the president, the Stan, who said that America is actually enjoying an exorbitant privilege. Because, you know, the world got a dollar's dominant position in the global system. Yes. The world is willing to lend to America, and America is able to live beyond its means. Yes. For example, if you or I have $500 in our pocket, you know, we are actually giving $500 of interest-free loan to America. Yes. And America is borrowing billions and billions of dollars every year and living beyond its means. Yes. So it's not as if America is doing the world a favor. So, and if, you know, like you said, is threatened tariffs on BRICS countries. Now, the point is, the dollar is not anointed as the world's reserve currency by an international agreement. It is the reserve currency because of the virtue of America's strong economy, its liquid and deep markets, its resilient and mature institutions which inspire confidence. So if BRICS countries, or indeed any other country, find that moving out of the dollar is less costly than staying with the dollar, they will move on, because there is no compulsion to stay with the dollar, and I don't believe how Trump can force that to happen.
Yes. You know, so many of our well-known or used to principles are getting thrown up. We don't know when the dollar also will start challenging us or, you know, move out of our daily lives. But let me come to the rupee itself now, coming back to India. We saw this sharp deceleration of the rupee. Would you blame it on the Reserve Bank? I mean, the Reserve Bank was accused of keeping the currency too stable.
Blaming is a strong word, but let's see what happened over the last 2 years. You know, America's growth was resilient, the dollar was getting strong. Consequently, the rupee should have depreciated. RBI should have allowed it to depreciate. Instead, they mounted defense, intervened in the foreign exchange market, maintained the rupee stable at a time when the rupee was actually overvalued in real terms. But over the last 3-4 months, the Reserve Bank has allowed the pressure to ease. So the rupee is now, I believe, finding its market level. But the more important point is, I think the Reserve Bank is institutionally more prone to intervention than is warranted.
Okay.
You know, we want to be, if you try to defend the exchange rate against fundamentals, there's a cost to be paid. Cost not just in terms of keeping reserves and using them, cost of distorting markets. You know, we want to be a developed country, we want to be a mature economy. If we want to be there, our market participants should be used to adjust to two-way movement of the exchange rate. If the Reserve Bank is seen to be intervening every time the exchange rate moves, they will never learn. In fact, they will outsource the risk management to the RBI, and the cost will be paid by the entire economy for the benefit of a few.
Fair point.
I agree that the Reserve Bank has to manage excess volatility, however that is defined.
Okay.
But not defend the exchange rate against fundamentals. Should not prevent the movement of the rupee, but engineer the trajectory of the rupee. That's what I would say.
Okay. Well, I want to discuss more about the rupee depreciation, especially because this time it's because of the capital account. But that will be after a commercial break. For Bazaar viewers, it will be time for Chartbusters, but you will get to hear the entire chat with Dr. Subbarao after market hours.